One forecast suggests U.S. growth of 3.6% in 2026 and similar in subsequent years. Real wealth demographic forces, e.g., aging populations, urbanization in emerging markets, will drive living/housing demand in new ways: senior living, multifamily, smaller households, co-living, etc. As the PwC report noted, too few developments catering to senior citizens whose ranks are growing by several thousand every day. PwC. The intersection of real estate plus infrastructure plus technology will grow. Assets like data centers, fiber-connected logistics hubs, energy transition real estate, e.g., solar-connected buildings, will become more important. ULI Europe plus one geographical winners and losers will diverge more than before. Markets with strong fundamentals, job growth, population inflow, affordable housing, good regulatory environment, will outperform. Markets burdened by oversupply, weak demographics, or regulatory drag may stagnate or decline. Also, the risk of correction remains in some segments. Although bubble risks have moderated in many global markets, they haven't disappeared entirely. UBS marks them as moderate. Australia implications and takeaways for different stakeholders. This means buyers/homeowners don't expect massive gains in most markets in the next several years. Priorities affordability, cash flow/rent versus buy analysis, and location fundamentals. Investors, residential and CRE seek assets with strong functional demand, modern amenities, location, tenant demand, ESG credentials. Legacy assets, old offices, outdated buildings, may face higher risk of obsolescence. Developers/project owners focus on cost control, construction, financing, differentiate the product, amenities, flexibility, sustainability, and choose locations and uses that align with where demand is heading. Markets/regions, location matters more than ever. Urban versus suburban, coastal versus inland, gateway city versus second tier, each will have different dynamics. Policy/regulators, housing affordability will remain a pressure point. Supply constraints, zoning/land use reform, and supporting infrastructure will matter. Specific considerations for Pakistan/South Asia and emerging markets. Since you are based in Pakistan, Punjab region/Kararianwala, it's worth noting how some of the above global themes may apply in emerging market contexts. Emerging markets often have different dynamics: higher population growth, internal migration, rural-urban, potentially higher real growth rates, though also higher risk. The global investors may pay less attention to smaller markets like Pakistan compared to large global cities, which means domestic fundamentals matter more: infrastructure, local financing, regulatory stability. If interest rates globally remain high, the cost of imported inputs, construction materials, and debt servicing may rise, which in emerging markets can suppress new development or raise prices. On the other hand, emerging markets may offer higher growth potential if they get the regulatory/institutional environment and infrastructure right. For an investor in Pakistan, it may be wise to evaluate growth of the local employment base, infrastructure development, roads, transport, regulatory ease, and whether the property offers rental/cash flow capacity or is purely speculative. Summary: in short, the real estate market globally is moving from a phase of sharp dislocation due to pandemic, supply chain, inflation, rate shocks, into a phase of rebalancing and more moderate growth. Big price leaps are unlikely in many mature markets in the near term, but there are still attractive opportunities, especially in sectors and regions aligned with future demand. For investors and participants, success will depend less on buy and wait for double-digit appreciation and more on smart asset selection, localization, operational excellence, and aligning with structural trends.